AAON delivered a massive earnings beat for Q2 2026. Adjusted EPS hit 69 cents, which completely blows past the consensus estimates of 48 to 51 cents.
Right, and revenue just doubled. I mean, they hit a record-breaking $626.98 million.
Exactly. That's up 101.2% year over year, just crushing Wall Street's $490 to $509 million estimates. Management then went ahead and raised their full-year sales growth guidance to a staggering 55% to 60%, up from their prior outlook of 40% to 45%.
But here's the catch. They simultaneously lowered their full-year gross margin guidance to 25% to 26%, which is down from 27% to 28%.
Yeah, and the stock reacted aggressively to that. I mean, despite the top and bottom line blowout, shares fell roughly 6% to 7% in regular trading, dropping to around $88 to $89.
Which really reflects some heavy profit-taking and, serious investor anxiety over that lowered margin outlook. The market essentially ignored the fact that revenue doubled.
All the institutional focus just immediately pivoted to those profitability metrics and what they mean for the company's future cash generation. So today we're doing a deep dive into a stack of Q2 earnings reports, 10Q filings, and recent insider trading logs for AAON Inc.
And if you're looking at your screen right now, wondering why a stock dropped 7% after doubling its revenue, you're basically running into the classic manufacturing paradox.
Right. It's like doubling the size of your house, but then realizing the new wing is entirely bleeding your heating bill. Your property value went up, but your month-to-month efficiency just took a massive hit.
That's a perfect way to look at it.
For you as a retail investor, our mission today is to dig into these filings and figure out if Wall Street is just overreacting to this margin guidance, or if the cost of scaling a heavy industrial business this fast is, a genuine structural red flag.
So to understand the market's reaction, we have to look under the hood at the gross margin compression, because this is the metric that spooked the algorithms and the analysts.
Oh, totally.
The core issue is the drop in GAAP gross margin. We're looking at a slide from 26.6% in Q2 2025 down to 24.3% in Q2 2026.
I mean, that is over 2 full percentage points. In the manufacturing world, that's not a rounding error.
No, not at all.
That represents millions of dollars bleeding out of the production process. So where exactly in the supply chain is that cash disappearing?
Well, the bleeding is highly localized. It was primarily driven by the massive operational ramp-up of their Memphis manufacturing facility.
Okay, the Memphis plant.
Yeah. According to the filings, that facility alone accounted for $18.1 million in unabsorbed costs this quarter.
Wow. Let's put that in perspective for the listener. What was the unabsorbed cost for that exact same facility in the prior year?
Just $3 million.
That's a huge jump.
It's massive. That specific dynamic at the Memphis plant created a 690 basis point pressure on their overall margins. And we should probably define what unabsorbed cost actually means on a factory floor.
Yeah, please do.
So imagine you lease and equip a colossal manufacturing plant. You're paying to keep the lights on, run the climate control, and you've hired hundreds of base-level floor workers. The overhead is fixed.
Right. Those bills are due no matter what.
Exactly. But because you're still ramping up production, you only have a fraction of the necessary widgets actually rolling off the assembly line. The volume simply isn't there yet to efficiently spread out those massive fixed costs.
I see.
So the cost per unit is artificially sky high until the line hits full speed.
And beyond the factory walls, they had to rely on temporary outsourcing and face broader inflationary cost pressures just to keep up with this, breakneck demand.
Yeah, that definitely added to the pressure.
But wait, I have to challenge this narrative a bit. You're framing an $18 million hit as just growing pains. But AAON has been in the commercial HVAC and manufacturing game for decades.
That's true.
How does a veteran management team miscalculate the cost of their own factory ramp up this badly? I mean, building the equipment seems to be getting dangerously expensive, and it feels like a failure of forecasting.
It is a valid critique of their forecasting for sure. But if you step back and look at the company's operating leverage, you actually see a completely different financial picture.
Okay, how so?
Well, while the gross margins, the cost of building the physical units, shrank, their SG&A, which is selling general and administrative expenses, dropped dramatically as a percentage of sales.
Oh, really?
Yeah, it fell from 19.0% down to 13.3%.
Man, that is a massive drop in corporate overhead percentage.
It really highlights the beauty of operating leverage. Corporate overhead doesn't need to double just because your revenue doubles. You don't need, 2 HR departments, 2 CFOs, or twice as much accounting software to run a second factory.
Right, those costs stay relatively flat.
Exactly. So while the factory floor in Memphis is sweating through this expensive, chaotic expansion, the overarching corporate machine is scaling highly efficiently. Revenue growth is vastly outpacing the investments needed at the corporate level.
Got it. So that disciplined SG&A management is what ultimately protected the bottom line?
Yep, leading to a 192% increase in operating income, which hit nearly $69 million for the quarter.
So the corporate suite is basically holding the line on costs to subsidize the friction on the factory floor.
That's a good way to put it.
And that scaling friction leads us directly into where this explosive growth is actually coming from. Because when you break down the segment performance in these filings, it reveals a fascinating structural paradox in AAON's product mix.
It really does. We are basically looking at a tale of two distinct brands here. First, you have the legacy AAON Oklahoma brand, which is their traditional commercial HVAC equipment.
Right, the classic rooftop unit.
Exactly. That segment grew by a highly respectable 39% to 41% year over year, generating over $262 million.
Which, honestly, for legacy commercial real estate heating and cooling in this macroeconomic environment is an incredibly strong number.
It absolutely is. But then you look at the BAS segment. This is the division that handles bespoke data center cooling and clean rooms.
And that's where the explosive growth is.
Oh, yeah. BASX wasn't just strong. It was an absolute rocket ship. That segment surged roughly 216% to 220% year over year, generating over $218 million in revenue.
And a massive chunk of that surge, $126.6 million, to be exact, was driven specifically by liquid cooling equipment for data centers.
Which is huge.
Right. This is where we need to start thinking about the physical realities of the AI boom. We always talk about artificial intelligence in terms of software, large language models, and NVIDIA chips.
Sure.
But running those chips generates an astronomical amount of heat.
And that introduces the margin paradox that is currently punishing the stock. Building advanced liquid cooling systems for high-voltage server farms is incredibly complex precision engineering.
It's not just blowing cold air.
Exactly.
Yeah.
It's a fundamentally different business than bending sheet metal for a rooftop AC unit on a retail store. Because it's so complex and highly customized, the BASX segment carries significantly lower gross margins than the legacy AAON brand.
So if you're tracking this as an investor, you see the dilemma here. The more successful AAON is at selling its absolute hottest product, data center liquid cooling, the more it artificially suppresses the company's consolidated gross margin percentage.
That is the structural reality they're dealing with. They are printing significantly more total gross profit dollars. In fact, total gross profit was up 84% year over year to $152.5 million.
But the percentages look worse.
Right. Because the lower margin liquid cooling segment is rapidly making up a much larger piece of the total revenue pie, the blended percentage looks worse on paper.
It's like opening a wildly successful drive-through lane at your restaurant. The drive-through brings in twice the revenue of your sit-down dining room, but with slightly thinner margins on each order because, I don't know, you have to pay for the specialized packaging.
Yeah, exactly.
You are depositing way more total cash into the bank at the end of the night, but your overall profit margin percentage drops. Wall Street spreadsheet purists see that percentage drop, and they panic, even though the total pile of cash is much larger.
And management is acutely aware of how the market perceives this mix shift issue. CEO Matt Tobolski spent a significant portion of the earnings call defending the strategy and, laying out a roadmap to reassure institutional investors.
So how do they plan to fix the optics? Like, how do you convince the street that this margin compression is just a temporary illusion and not a permanent degradation of the business?
Well, Tobolski was definitive. He stated that margins will improve sequentially in the second half of the year, with the fourth quarter expected to be the high water mark for 2026.
Okay, that's a bold claim.
Yeah, and for the legacy AAON Oklahoma segment specifically, they are targeting a return to mid to high 30% gross margins by Q4 and into 2027.
Going from 24% consolidated back up into the mid to high 30s for a segment is a massive leap to execute in just 6 months. What's the actual physical mechanism that's going to drive that recovery?
The mechanism they're relying on is called price-cost realization.
Okay, break that down for us.
Sure. To understand how this works mechanically on the factory floor, we had to examine AAON's backlog. Their total backlog actually shrank sequentially by 7.4%, dropping from $2.13 billion down to $1.97 billion.
Wait, let's pause right there. A shrinking backlog usually sends investors running for the exits.
Usually, yeah.
It implies demand is drying up and the company is eating into its reserves just to keep the lights on. Why is a shrinking backlog a positive catalyst for their margins right now?
In a normal, stable economic environment, you'd be right to worry. But in a period recovering from historic supply chain inflation, a shrinking backlog is exactly what you want to see.
Really?
Yes, because the Memphis facility is finally ramping up and converting that backlog to revenue so fast, they're flushing out older, lower-priced contracts.
Wow.
These are deals that were signed and priced quarters ago before the cost of copper, steel, and specialized labor spiked.
I see. So if they agreed to build a cooling unit for $1 million back in 2024, but by the time they actually build it in 2026, the materials cost them $900,000, their margin is completely squeezed.
Exactly.
So they are currently clearing the pipes of those less profitable legacy deals.
That is the exact dynamic. As they rapidly work through that backlog, which we should note is still up 98% year over year overall, the newer contracts will begin to hit the assembly line.
And those have better margins.
Right. Those newer contracts were negotiated with updated, much higher pricing that accurately reflects the current inflationary environment. That is price-cost realization in action.
The pricing finally catches up to the underlying costs.
Exactly. It naturally lifts the gross margin, but there's always a lag. It takes a few quarters for those newer, better-priced contracts to make their way off the factory floor and onto the income statement.
Well, the narrative management is spinning certainly makes logical sense. Flush the bad contracts, let the good contracts flow, and watch the margins expand in Q4.
Right.
But as a prudent retail investor, you cannot just take management's rosy projections at face value. We have to tear into the balance sheet and look for the hidden operational risks that could easily derail that recovery timeline.
And the 10Q filing provides several yellow flags that demand closer scrutiny.
Let's hear them.
The most glaring issue sitting on the balance sheet right now is warranty costs. Their warranty accruals jumped to $36.6 million.
Oof, that's high.
It is. Even more concerning, the actual year-to-date warranty expenses, the real cash they had to pay out to fix broken equipment, hit $16.9 million. That is up drastically from just $6.8 million in the prior year.
Okay, this is where we really need to connect the dots. I understand that scaling a massive factory fast is a messy, chaotic process, but spiking warranty costs are a huge red flag. And let's combine that with the insider trading activity hidden in the filings. There have been 17 open market insider sales and absolutely zero insider buys over the last 6 months.
Yeah, that's not a great look.
Now, I know executive compensation is tied to stock, and taking profits after a massive run-up is standard practice. But when you have executives aggressively cashing out at the exact same time that warranty costs are exploding by over $10 million, it forces a very uncomfortable question.
Which is?
Are the insiders selling because they know the Memphis plant is rushing production and shipping defective units to meet these aggressive revenue targets?
That is the ultimate operational question, and it should be the primary metric you monitor in the upcoming quarters.
Right.
Is this warranty spike simply a mathematical function, meaning if you double your sales volume, your total warranty expense naturally doubles? Or is the actual defect rate climbing because quality control is slipping during this hypergrowth phase?
And if it's the latter?
If the defect rate is climbing, the cost to send technicians out to repair massive HVAC units in the field will devour their cash, and that Q4 margin recovery timeline gets pushed out indefinitely.
What other liabilities are sitting on the balance sheet that could constrain them?
Well, we have to look at their debt profile and leverage. Long-term debt currently sits at $435 million. They're utilizing a large chunk of their $600 million revolving credit facility to fund this expansion.
Okay, so they're borrowing heavily.
Yeah,
Oh.
that puts their leverage ratio at 1.46x. While 1.46x isn't catastrophic for a heavy industrial company, it means they're taking on real financial weight and increasing their interest expense burden at a time when rates are pretty unforgiving.
That makes sense.
Furthermore, management explicitly noted softness in the broader commercial HVAC market. Even though AAON is successfully taking market share with their legacy products, the macro environment, specifically commercial real estate construction, is fighting them.
So if we synthesize the bear case here, they are swimming against a softening macroeconomic current in their legacy business. They're drawing down heavy debt to build out factories for the data center boom. And they're dealing with a potentially troubling spike in warranty claims as they struggle with quality control.
That's the summary, yeah.
It sounds incredibly risky. But the cash flow statement tells a slightly different story, doesn't it?
It does. It provides a massive counterweight to those risks. If you look at the operating cash flow for the first half of the year, it flipped to a positive $55 million.
Wow.
Yeah, that is a staggering improvement from a $31 million cash burn in the same period last year.
I mean, that is an $86 million swing into positive territory in just 12 months.
It really proves that the underlying business model is fundamentally sound. Despite the heavy capital expenditures, the $18 million in unabsorbed costs bleeding out of Memphis, and the massive inventory build required to support 100% revenue growth, the core operations are generating real, tangible cash.
So they're not just surviving on debt.
Exactly. They are funding a significant portion of this explosive, chaotic growth through their own daily operations.
So what does this all mean for you, the investor managing a portfolio in the middle of an AI supercycle? We are constantly bombarded with news about the AI revolution, but the conversation is almost exclusively focused on software, large language models, NVIDIA chips, and digital infrastructure constraints.
Right, the narrative is always about digital bottlenecks, chip yields, processing power, and data latency.
But AAON's earnings report rips the lid off the actual physical bottleneck of the AI boom, which is thermal dynamics.
Absolutely.
The constraint isn't just processing power, it is literally keeping the servers from melting into slag. The power density of these new AI chips requires an entirely new generation of liquid cooling infrastructure.
And that infrastructure is incredibly difficult and expensive to scale. I mean, the tech giants can write blank checks for servers, but those servers are useless if the physical buildings housing them cannot dissipate the heat.
If data center liquid cooling is the ultimate picks and shovels trade of the decade, the provocative question for you to ponder is this: how much heat, friction, and margin pressure can this secondary physical supply chain endure before the infrastructure physically caps the AI software boom?
That's a great question.
If companies like AAON are struggling with the immense friction of scaling up their factories, dealing with unabsorbed costs, and fighting spiking warranty claims just to meet current demand, that friction eventually rolls uphill. It becomes a physical constraint on the tech giants deploying the software.
Definitely something to keep an eye on.
Something to think about the next time you ask an AI a complex question and hear a server fan spin up somewhere in a data center hundreds of miles away. That is all for today's deep dive. Make sure you follow the feed for your daily, no-nonsense earnings coverage.